Welcome back to the Daily Crypto Roundup. If you're here every day, you already know how we do this. Straight through the tape with the numbers first and the noise second. And if you're new, welcome in. This is where we cut the hype, lay out the moves, and talk about what actually matters when you're staring at a red screen. Today has been one of those days where the market doesn't just dip, it breathes out hard. Leverage flushed, bids thin, and headlines hitting in clusters. We're going to walk through the lot, the liquidation wave, the break under key levels, the big wallets moving size, the exchange expansion that almost got buried by the chaos, the central bank warning shot at stablecoins, the sudden spike in Satoshi bets, and the weirdest line you'll hear all week. A stablecoin glitch printing fantasy money before vanishing back to zero. Before we do any of that, do the two things that genuinely help this show grow. Hit follow and drop a 5-star rating. It takes a second. It pushes us up the feed. It keeps independent crypto coverage alive. Thank you. Let's get the numbers on the board. Bitcoin is trading around $106,700, give or take, down about 1% on the day, and still heavy after the liquidation rush. Ethereum sits near $3,800, off roughly 2%, with intraday swings that tell you funding got messy. BNB hangs in the low 1,000s. Solana is hovering just under 200. XRP is mid $2. Cardano's around 68 cents. Dogecoin is near 20 cents even. Tron holds around 31 cents. Chainlink's just south of 19. And Avalanche sits in the low 20s. Here's the heartbeat of the day. Leverage got smoked. More than $1 billion in crypto derivatives positions were taken out in 24 hours. And most of that pain hit the long side. Traders leaning into a bounce that never arrived. If you've been around for a while, you know the script. It doesn't start with panic. It starts with math. A few oversized positions edge close to margin. An algorithm takes the wheel. One forced sale trips the next, and within minutes you've got a chain reaction that looks personal but isn't. It's electricity. It's plumbing. It's gravity. When the first wall of liquidation sells, bids step back and the market falls through pockets of empty air. You can almost hear it when you watch the order book pulse. The first hit, the vacuum, the second hit, the scramble. Ethereum took the largest slice of that damage this time, and you could see it in the perpetuals. Funding flipped, open interest dropped, and the path of least resistance pointed lower. The only mercy in these moves is the mercy that comes after. Leverage flushes, funding normalizes, and price action becomes honest again. But you don't get that calm until the system finishes chewing through the excess, and today it still had jaws. Now the level that broke mattered. Bitcoin slipping under 106,000 wasn't just another red candle. It cracked a month-long shelf that traders had turned into a habit. Habits are dangerous in markets. You start to think a floor is a law, not an agreement. Then macro throws a punch and the agreement gets ripped up in public. That punch, by the way, had a name. The return of risk-off tone after a hawkish reading of Jerome Powell's latest remarks. He didn't raise his voice, and he didn't say anything reckless. He did what central bankers do when they want financial conditions to stay tight without doing anything dramatic. He suggested patience. He hinted at persistence. And he made it clear that inflation progress can stall if liquidity loosens too quickly. That's code the bond market reads fluently. Yields nudge up, equities fidget, and the riskiest corner of the risk curve, that's us, gets pushed first. None of this is fatal to the long-term crypto thesis. It just compresses the short-term air out of the balloon. Then came the flow that put a headline on the sell-off. Several whale-watching dashboards flagged unusually large transfers linked to major names: BlackRock, Binance, Coinbase, moving size within a tight window. Whether that was coordinated, coincidental, or simple internal routing, it hit like a cymbal crash in the middle of a violin solo. The number doing the rounds was about $1 billion in Bitcoin, moving over roughly 6 hours. When order books are thin, because algos are already liquidating and bids are defensive, size like that doesn't sneak through the side door. It walks in, and everyone sees it. Veteran market makers will tell you the same thing over a beer. The amount matters less than the timing. And the timing was awful. You don't dump a truck of gravel into a stream that's already overflowing and expect a gentle ripple. That is the moment you either step away from the keyboard or you scale way down. Because your read of value doesn't matter if the book can't breathe. There was one piece of actual business news that deserved a cleaner runway than it got. Kraken buying a US derivatives venue. Small exchange isn't a meme name. It's a CFTC-licensed market with the right permits to list regulated futures and option products domestically. Kraken writing a 9-figure check for that platform is the kind of move you make if you plan to be around in 10 years. It's also a quietly important signal to US regulators. If you give this industry clear lanes, serious firms will drive in them. It means properly sized contracts, better margin treatment, and the chance that real hedging tools become standard for everyday traders instead of a privilege for institutions at the CME. It also suggests we're inching back towards a world where the biggest exchanges look and act like financial companies, not casino apps. Boring where you want them boring, innovative where it actually helps. While the industry was trying to grow up, the referee raised a whistle. The Federal Reserve's Michael Barr didn't aim at Bitcoin or Ethereum. He went straight at the plumbing: stablecoins. He called out the obvious tension everyone lives with. Private companies issuing instruments that behave like digital dollars without living under the same rules as banks. If you depend on stablecoins for your flow, and if you trade on centralized venues or DeFi, you do. You should want grown-up supervision. Not because you crave rules, but because you crave survivability. Redemption lines need to work under stress. Reserves need to be real, verifiable, and preferably boring. If the path from a stablecoin to a dollar in a bank isn't short and dull, it isn't a payment instrument, it's a promise. Markets can trade on promises for a while. They can't settle on them forever. And yet, because this is crypto, as soon as we have a sober conversation about systemic plumbing, the circus opens on the next block. The Polymarket contract about whether Satoshi Nakamoto will move coins this year suddenly lights up. Odds jump, narratives bloom, screenshots fly. There's a reason that happens when volatility rises. When people feel like they're not in control of the near future, they tell ghost stories about the distant past. Satoshi's keys are the industry's original campfire tale, a reminder that somewhere out there sits a stash that never blinks. Every time that bet spikes, I read it as a sentiment thermometer, not a forecast. Nerves are high, attention is up, but apathy hasn't set in. As long as the market can still joke about its founding myth, you haven't hit despair. You've hit uncertainty. Now to the glitch that made traders double take, and briefly made PayPal's stablecoin look like it had more money than the entire world. Paxos, the company behind PayPal's PYUSD, accidentally minted $300 trillion worth of tokens on the Ethereum blockchain. It wasn't a hack or a rug pull. It was a decimal point error during a routine transfer, a simple coding misalignment that caused the system to add far too many zeros. Within minutes, Paxos engineers spotted it, reversed the action, and burned the entire $300 trillion supply back to zero. During those few minutes of chaos, DeFi protocols like Aave froze their PYUSD markets to prevent any risk of contagion. The correction was quick, no user funds were affected, and the total supply returned to normal. But the reputational damage lingers. It showed how one line of faulty code can instantly distort an entire market's optics. A reminder that when you're issuing money on-chain, precision isn't just technical, it's existential. Underneath the noise today, there are 3 currents you should hold on to if you're positioning your portfolio, rather than doom-scrolling your feed. First, deleveraging is not destruction. We've seen bigger liquidation walls in the past, and the market didn't just recover, it hardened. If you strip out the forced sellers and you're left with spot buyers who weren't shaken by Powell's tone, that's a foundation. Second, structural rails are still being laid. A regulated US derivatives footprint acquired by a top-tier exchange during a red week tells you the grown-ups are building during the storm, not after it. Third, the policy conversation on stablecoins is maturing. The Fed's language sounded stern, but the subtext wasn't bannish, it was bankish. Bring reserves up to code, make redemption boring, make supervision real, and then let the market scale. If that's the path, it's bullish in the boring way that counts. So what do you do with that if you're holding coins and trying to keep your head? First, size like a professional. If this volatility is giving you heartburn, your position is too big for your time horizon. Second, separate narratives by half-life. Whales moved size has a half-life of hours. Kraken bought a licensed derivatives venue has a half-life of years. Allocate your attention accordingly. Third, spend 10 quiet minutes looking at your own infrastructure. If your long-term stack is sitting on an exchange you don't actively use, move it. If your backup phrases live in your Photos app, fix it. If you don't have a hardware wallet, get one. Exchanges freeze when you most need them. Your cold storage doesn't care. Back to the screen for a second. When you see carpets of red like today, the temptation is to mash buttons, to sell your winners with your losers, or to buy the dip because your pride doesn't like being on the sidelines. Neither of those moves is a strategy. They're emotions with a password. The only reason to sell here is because your thesis changed or your risk did. The only reason to buy here is because you were patient enough to plan your entries when other people were euphoric, not because the candle looks dramatic. Volatility will hand you trades every week. Patience will hand you returns every year. There's also a quiet positive in the way the market handled the chaos. We didn't see cascading exchange outages. We didn't watch a major stablecoin wobble off its peg. We didn't read about liquidation engines failing. That isn't an accident, that's architecture. After every cycle, the industry learns. It writes new code, it installs new circuit breakers, it upgrades the margin logic, it keeps the lights on. Price can scream, crisis, for a day, while the pipes hum along underneath. That's how real markets look. Messy at the surface, boring in the basement. As we start to land this, let's circle the order of the day one more time so you have it in one breath. The day belonged to the liquidation wave, the break under support, the badly timed whale moves, the one exchange buying a regulated foothold while others duck, the central banker who told stablecoins to dress like banks if they want to be money, the prediction market that lit the Satoshi signal to cope with its nerves, and the stablecoin glitch that reminded everyone why boring is beautiful when you're dealing with dollars. That is the tape. That is why the board is red. That is why your job tonight is to protect your edge, not prove a point. 2 final notes before we close. First, gratitude. The messages, the shares, the ratings, they actually move the needle. If you haven't yet, hit follow and tap the 5 stars. It's the simplest way to tell the algorithm that you value independent, non-sponsored coverage in a space that loves a shill. Second, security. I'm going to say it every time the market shakes. Self-custody is not an accessory. It's table stakes. If you don't hold the keys, you are renting your net worth from a website. Get a hardware wallet, set it up properly, and sleep like a person who still has access when the rest of the world starts asking support for withdrawals. The link is in the description if you need it. Take a breath. Let funding reset. Let the weekend liquidity games play out without your whole stack on the table. There will be a next move, and there will be a next rally. Your edge is that you're still here, you're still calm, and you know how to separate what matters from what just makes noise. Thanks for riding the red day with us. Follow the show, leave that 5-star rating, share it with someone who could use a steadier voice, and we'll be back tomorrow with whatever the market throws next. This has been your Daily Crypto Roundup, and as always, we'll see you at the top.